Gotta make sure to turn it on. Bonds are a promissory note which is a promise to pay. Okay, that's why it's called promissory. Oops, promise to pay a certain amount of money at a point later in time. Okay, so kind of like the CD, you know, you put the money in and they give you a certificate that said, we'll pay you X amount of dollars after 6 months, after a year, after whatever. So promissory notes are the same thing. They're a promise to pay back. The difference is bonds work a little like stocks do. Okay. They have ups and downs. They can be purchased through a broker. Okay. Bonds are a way for a government or public entity to get funds from a group of investors. So it's a group thing, not just a single thing. Now, government and public entities means, and we're going to clarify this slightly, companies that are not traded on the stock market, nonprofit organizations, okay, and government agencies. Government agencies include the schools. So we'll put that up here with the government. Schools, cities, counties, states, and federal. So on all levels of government, okay? I want to add in certain amount of money at a time later, at a certain interest. They do pay interest. I forgot to add that in there, I apologize. Okay, so the government agency, the non-publicly traded companies, they issue bonds. They're a loan, not a purchase into the company. Because remember, when you get a stock, you're considered a co-owner in the company. Bonds are a loan to the company. Bonds are a loan to the state, a loan to the school, a loan. Okay. Versus the stock, which is a purchase in, a co-owner. So that's why it's the companies that are not traded on the stock market. Because remember, they don't want people to co-own with them. Okay. So we're going to talk about how these bonds work. How the bonds work. Back. How bonds work. There are several types of bonds, and each one works a little bit differently. Okay. First type of bond is a U.S. Treasury bond. Okay. Sold to help fund U.S. government. Oops, sorry. Special projects. Okay. So there are special things that come up that the government wants to fund. They don't want to have a long-term funding for it in the budget. It's a special one-time thing, so they don't want it as a line item of the overall budget. So they sell bonds, and they use the bond money to help fund that special one-time thing. Okay. They are guaranteed to be repaid because they're U.S. government. The interest earned is taxed by the IRS. But not by the state. So you do have to put it on your tax return for the US government, but you do not have to put it on your tax return for the state of California or whatever state you live in when you end up getting them. They are purchased through a specialized secondary market just for this type of bond. So on the stock market, you can see stocks and bonds. So your broker that deals with buying stock for you can also deal with buying bonds for you. They have a market for them similar to the stock market, but not quite. It's not them yelling at each other and stuff. Okay. Some of them earn interest along the way. Okay. While others are purchased for a discount. Instead of paying interest. Okay, so what we mean by that is the ones that are the discount ones. What ends up happening is you could buy a $500 bond, but only pay $400 for it. Okay. So basically, up front, they're giving you your interest because you bought it for $400 and they'll pay you back $500 later. Okay. Or you could buy a $500 bond and get 3.5% interest, for example, at the end. Okay, so there are two slightly different types of bond. Some that'll give you interest, some that you buy for less upfront, so you get the benefit right away. Okay, questions about the Treasury bonds? Okay. The next kind of bond is a federal agency bond. Okay, federal agency bond. Predominantly, this is the Federal Housing Association. I don't know how to spell association sometimes, which is called FHA. And government national mortgage. Oops, I can't spell. Association, which is abbreviated sort of Ginnie Mae. Sell the bonds to fund housing projects for low income. So they sell the bonds so that they can go ahead and help a low income family who's trying to purchase a home. They give them their mortgage on their home. So they're borrowing the money to buy their home from these two agencies. Okay. And then they pay them back, and that's what pays back for the bond. So they're giving the low income families a chance to purchase a home, and the interest rate on those mortgages is lower. But there is an income criterion to be able to qualify for these homes. They're intended to help the low income families get their step up and into regular housing instead of having to rent or instead of having to that kind of thing. So they can actually be homeowners. All right. And that's what we're putting right here. Used to buy mortgages for the low income families to encourage home ownership. Because if they can get the families into their own home, okay, give them anchor, give them roots, because if they own their home, it creates stability. And once that stability gets created, it can travel for generations and start breaking the cycle. Okay? Because when you own a home, it's a really big mentality difference than when you rent. If you rent, it's not yours. Something breaks, it's like, oh well, I'll just tell the landlord, no big deal. But when you own it, you take pride in it and you're more willing to go ahead and upkeep it and keep it nice and treat it well. As opposed to this is somebody else's thing that I'm just borrowing. So they want to get people anchor and roots. So they have these two agencies that do that. Okay. The mortgages, the percent on them is cheaper because they know the low income families can't afford the same kind of percent. Okay, the next kind is called a municipal bond. Municipal bond. Okay, municipal bonds are state and local governments sell them to fund large public projects. Okay. Now, these large projects, these state and local, and even the state and local and they have to get the voters' approval. These require voter approval before the state or local government, which would be the city or the county, sells them. It also includes the schools. So, because remember, these are loans. This is putting the state into debt. This is putting the county into debt, the city into debt, the school district into debt, because they're getting a loan from these people that they have to pay back. So before that can happen, they have to get the voter approval. So these are part of what appears on the ballots. Okay. Oftentimes they're called proposition this, or they're with the state ones, they're usually numbers. With the county ones and school ones and city ones, they're usually letters. So state propositions are what these are called. State propositions, those are numbered. Or the county, city, school are letters. These are called propositions as well. So around election time, you'll hear Proposition 16, Proposition 42, Proposition X, Measure Y. Okay, those are, so the city, county these are called measures, that's right. Measures. Okay, so when you're hearing this voting stuff that's going on, and you know it happens for like at least 6 or so months before the voting happens, you'll hear about proposition, that means it's a state. You'll hear about measure, that means it's a local, so that's county, city, or school. So measure Y, proposition 13, that kind of thing. Those are bonds or other things that are happening that require voter approval. Okay, so they cannot sell them unless the voters say, yes, we allow you to go into debt. And the reason why is the voters are the ones that pay it back in the long run through their taxes. Okay. These do not pay federal tax, federal income tax, to the IRS on the interest. And might not have to pay state or local tax, but it's a might. It depends on which one you get and things like that. And this usually happens if you live in the area where the money is used. Because you can buy these bonds off a market, and you could buy ones for Michigan, but you live in California. So you will pay taxes on that interest because you live in California, but they're for Michigan, okay? At the state level, the California state level. But if you live in San Joaquin County and it's a bond for San Joaquin County, then you won't pay taxes on it because it's a bond for you. It's for your benefit, okay? There is a slight chance that the bond will go unpaid. Okay, there's a small chance that you don't get your money back, that the paper you get is not worth anything. And that is because cities, states, counties, and school districts can file bankruptcy. Okay, and if they do, their debt gets written off just like for a regular person who files bankruptcy. So there have been cities that have gone into bankruptcy. They have an agency that comes in and restructures their debt, and their bonds, get written off. And sometimes they can pay a little bit of them, but maybe you bought a $500 bond, but they only pay you back 10 cents on each dollar. So if you bought a $500 bond times 10 cents, how much money would you have gotten back? 55? Yeah. There are times when that happens because they can file bankruptcy just like a human, just like a regular person. It's few and far between that happens, but it is a possibility. Okay, there is one more type of bond, and then we're going to talk about another way to invest. This is corporate bonds. Any government other than the federal government can file bankruptcy, yes. So states can file bankruptcy, cities, counties, and schools. So that's why at these municipal bonds, you could end up not getting repaid completely. Corporate bonds. Okay. Corporate bonds are sold by large companies who are not traded on the stock market. Okay. To raise money without giving up partial ownership. Okay, because they don't want to give up their ownership. Stocks give up ownership. Okay. Solid, larger companies have a lower risk. Like, duh. If they're big and they're established, there's a lower risk of losing the money. There is more risk than with stocks. Because these can be written off in a bankruptcy because they're a loan. Same thing. Okay. So there's a chance you might not get repaid. Chance might not get repaid. No, because stocks are ownership in the company. If a company goes bankrupt, then they have to pay off their owners, and stocks are owners. But bonds are a loan. And just like any other debt, when bankruptcy happens, debt can be written off. Again, this is usually where they pay you back part of it. Okay. Bonds from high risk companies. Now, these are usually companies that are smaller, unknown companies. Those are usually the higher risk ones. They're startup companies. They're just getting their foot in the door, so they need to sell bonds to go ahead and get going. Okay. Stocks from this type are called junk bonds. So if you've ever heard, and if you listen to the financial stuff, you'll hear them talking about junk bonds. And they are high risk, but high profit. Okay, so with a bigger risk, you get a bigger reward. And corporate bonds are bigger risks than municipal bonds. Okay, so it kind of goes in tiers, like the US Treasury bonds, super safe. The government will pay those back because the federal government cannot go bankrupt. I guess they just print more money to make it work. I don't know. Feels like they go bankrupt sometimes, but no. Then there's the federal agency bonds, the Fannie, the FHA, and the Ginnie Mae. They could get a little dicey sometimes, but it's highly unlikely because they're backed by the federal government. Okay. Then you go into the state, county, city, school, the municipal bonds. Like I said, a little bit on the dicey side because of the fact that there have been cities and states and school districts and stuff that file bankruptcy. And then the corporate bonds, biggest risk, but they're also the biggest reward. Okay, you get the highest percent return. So this one gives you the highest percent, oops, spell that right, return. These things, I've seen some of these bonds that are going at 16, 18, 20% return on your money. Yeah, Treasury bonds pay the least. Yeah, it goes in tiers like that. The bigger the risk, the more the percent that you're going to get return-wise. The Treasury bonds used to be called savings bonds, and grandparents would buy them for grandchildren as these gifts, and they'd give them a $25 savings bond or a $50 savings bond. Yay! And then in 10, 20 years, when the kid was older and they wanted to go cash it in, they were usually worth, a $25 savings bond could be like $37. It took forever for it to become anything. I think the shortest they were was a 10-year. So I remember when I was younger, I had a whole stack of them. When I turned 18, I was all excited. I was going to finally get a lot of money because my grandparents would give these to me, one a year at birthdays or whatever, because they lived away from us and they didn't want to send cash. And that was back when they didn't have gift cards and stuff, right? I took them in and, the $25 a year, I think I got maybe $150 total or something like that. It wasn't even that much, but it felt like a big deal at the time, It's perspective, right? Okay, so that's it for the bonds. So we're going to back up. We are now going to talk about a thing called mutual funds. And I have actually mentioned mutual funds before. Okay, I've mentioned mutual funds before when we were talking about our investment stuff. Now, mutual funds sell shares to investors to get a pool of money to invest in various types of other investments. So it's their job, it's their job. People buy into these mutual funds because then all their money collectively can be used to go buy stocks and go buy bonds and stuff. So they're often for the big retirement plans and stuff. We talked about that. It is a professional team, manages the other investments for the whole group. It gives them more buying power and stuff like that. Investors see increases and decreases based on the overall performance of the fund's other investments. So they look and see, like the fund might be buying, the fund might go out and they want to buy a big batch of technology stocks and a big batch of these kind of bonds and a big batch of, and depending on how those various batches are doing, one batch could be going up, one batch could be going down. The net is what makes a difference in how the mutual fund reacts. So if their investments they made as a mutual fund as a whole are all going down, then the mutual fund's value is going down. Sometimes it's stable. No, the mutual fund, remember what I said, mutual funds in general are your pensions and things like that. So a company sets up a 401k pension plan for its employees. A mutual fund is what manages those investments for the employees. Or so like I have state teacher retirement. There's a big mutual fund called State Teacher Retirement. They go ahead and they're taking my money and investing it in a whole bunch of different things, all the teachers' monies, and investing it in different things. So it's a bigger pool of money to invest in different things to try and earn us more. but it's for the pensions and stuff. But you can, as an individual on the stock market, these mutual funds are out there and you can buy stock in them, even though you're not part of that pension plan. And if you noticed on the game, there was a place to buy some mutual funds and stuff. These are attractive to investors because there's a few reasons. First reason, pooling large amounts of money means, they have a wider range of investments okay, and we talked about it in one of the assignments. What does that mean when you have a wider range of investments? Starts with the letter D. Anybody remember? Diversified, yeah. It means you're diversified. And yeah, diversified, yeah. Let's spell it right though. This is the one I want. Okay, by being diversified, okay, it means they have a wider range of investments, they're diversified. So the risk, if one company or industry is not doing well, is reduced by others who are doing well. So there's a balance happening. So you might have one piece of the mutual fund going down, but this other piece over here is going up a lot better, which means overall the mutual fund is going up in value. By being diversified, it reduces the chance that you lose all your money. But that's one of those things that happened is people used to invest only in tech stocks or only in car industries or only in, and then when that industry went bad, and there's always goods and bads that happen, life happens, then they would lose a lot of money and freak out. But by having them in a whole bunch of different sectors is what they call those, it makes it so that if this particular group isn't doing well, this one more than likely might be. Okay. The other thing about the mutual funds that's good is the advantage of mutual funds is they are managed by professionals who have experienced people working for them. Who know how stocks and bonds work. So you don't have to sit there and go do your own research and make sure you pick the right company and stuff. They have people who are trained for that and they manage the fund for you. And so you can put the money in and then put it in and not have to worry about it. This way or that way? This way, okay. I never know which way's up. All right. So it makes it so that you can invest without having to micromanage it. unlike when you're just doing stocks and bonds for yourself. And you're not necessarily paying this big fee to a broker to handle it for you and stuff like that. Can I scroll up now? I was stalling because I need to fit more. Okay, back up one. Now funds, the mutual funds, mutual funds are rated by their risk level. Okay. So some mutual funds are intended to be big growth funds. So they put the stocks, they put their investments in the big growth areas. And that means that there's more risk happening. So they get a higher return. Okay. Okay. Some funds are meant for that long, slow, steady growth because they know we have a long range plan. So they're not necessarily going to be looking for the highest interest. They're going to be looking for the steady income interest. Okay. All right. So we're going to add that in here. Some go for big growth. So they are riskier. And some go for the steady growth. So they're stable. And obviously, remember, just like we said, riskier, bigger reward, stable, smaller reward. So the riskier ones have higher interest. And the steady ones have lower interest, but they're planned for the long range. Just like with anything else. Okay, oops, just like with anything else. You want to, I did want that there. You want to look at what is your plan, and you want to have your money in some that are risky and some that are stable so that you diversify within the mutual funds, just like anything else. You want to stay diversified. Some of your money is in risky stuff. Some of your money is in stable stuff. Some of your money is with guaranteed payback. Some is with, so that you have a balance. Okay. Oops, where did you go? They can be bought through a broker, just like stocks. Okay. And they vary in the fees they charge to manage the funds. Okay. There's another kind. So we talked about stocks to start. Then we talked about bonds. We talked about mutual funds. This is our, there's two more. This is called exchange traded funds. They're abbreviated ETFs. Okay. They are similar to mutual funds because they provide diversification. But mimic stocks Okay, they mimic stocks, stock indexes, sorry, like Standard and Poor's 500. Standard and Poor's 500 is S&P 500. And what those are, those should be capital, sorry. What the S&P 500 is it's 500 products and stuff that get watched, and the fund increases or decreases based on what's going on with those 500 top companies. Often, sometimes they're called the Fortune 500. Okay. These have lower management fees. They are bought and sold like stock. And because they are easy to buy and sell, so they attract small investors. Because you can get into them for, you know, $100 or whatever. And they're watching. It's kind of a blend between a mutual fund and a stock. Now, there are other ways you can invest. Okay. Other ways to invest are things like real estate. Now, real estate, when we invest in real estate, is you buy a home instead of renting. You're investing because, remember, when you own it, it goes up in value. When you rent it, it does not. Okay. Now, the thing with real estate, though, prices go up and down just like anything else. Prices go up when there are more buyers than sellers. So if there are more people that are wanting to buy, but not that many places to buy, the prices go up. Prices go down when there are more sellers than buyers. So if in a particular area there's a lot of people selling their home all at once, then the price will go down. If there's a lot of people wanting to buy into an area, but there's not many to buy, prices go up. Another benefit of buying a home is buying a home has tax benefits. So you're investing because the home's value goes up, but you also are investing because there's tax benefits. Okay? But you don't only necessarily buy a home for yourself. You can buy, I want that, rental property. That's to rent to others. Commercial property. Which is to rent to businesses. Okay. Only catch with that is you have to be willing to monitor what the renters are doing to protect your investment. Or you have to pay a company to monitor for you. Okay? Because like I said, when you rent, there's a different mentality. This isn't mine, so oh, no big deal if the backyard looks kind of crappy because it's not mine. As opposed to, I own this, I want this to be nice looking. Okay? Another thing is you have to be willing to pay for the maintenance and upkeep so your investment keeps its value. So you have to pay to replace the roof. You have to pay to have it painted. You have to pay for the yard work. You have to pay for, that's all money coming out of your pocket. So that's why, you know, the rent is the way it is, because the person has to pay for the mortgage payment, plus they have to pay for these other things. The last way you can invest in small businesses or own your own. Okay. We're going to add a figure from the book. So let's get our book open. Get the book open, please. I need to know what PDF page it is if it's 275 of the book. So we're getting rid of this. We're going to put some pictures in from the book. I added the link in to this week's. What PDF page number is regular book page 275? $294. Okay, so go down here. Open in Cami, we can do this little type and get to where we want to be. What we want off of page 294 is, yes, this little figure 4.4. So remember, Shift, Control, and the button above 6. So you are just getting the little piece that is figure 4.4, not all the words around it and everything else. So Shift, CRTL, and the button above 6 will make it gray like that. So you could just get this little tiny piece. I don't want the whole page. You don't want the whole page. And then we have to copy it and put it on our document. Notes. Okay. The other thing we need is figure 14.5. So that's the next page on our PDF. If I can get back to it. Help me. Quit it. Nope. Yep. 14.5, which is this one about the ratings. Because remember I told you the bonds are rated and the mutual funds are rated. Okay, so we want this one as well. But I only want you to get this little piece that's figure 14.5. We don't need all the rest of it. That's just extra. And if you go ahead and switch to the middle and you switch to no margin, You'll be able to put the two of them next to each other. If you want to go ahead and make them the whole page, or just top to bottom on the same page, that's fine. Where'd you go? Uh-oh. Let me back. I want you over here. It'll be fine. Okay. So that's it for the notes. That's the last notes. Put those two figures into your notes.